care about them? A, you'd like to get a decent grade in this class. I know you all feel that way. So that's one reason I'll give you. But why do people in general care about bonds?
Type of investment.
Okay, good. It's type investment. What else?
Helps companies.
Okay, that get liquidity. So it's a way to raise funds, right? So how does it differ from other ways to raise funds? Okay, it doesn't give people ownership. Good. So it's a different type of fundraising instrument from the company's perspective that makes it kind of desirable. And then on the flip side, from the consumer side, what does it give them? They're not owners, so what's the benefit or pro or con to that? What does it give the consumer of the bond or the buyer of the bond?
Interest.
What's that?
Interest.
Interest, okay. And the coupon payments. And how is that different from the dividend? I mean, why would an investor maybe find that desirable? What's different about that compared to a dividend that a stockholder might get? It's a little safer potentially, not completely, but it could be. And I'm sorry, what?
It's fixed.
It's a fixed amount. It's a little more sure. It's a little more certain. Okay? So from a financial planning standpoint, that might be important if you're looking for a fixed income stream. So that's how these instruments differ from each other. So it's good to kind of think of bonds as just a good, I think, in this context. So we last time developed the bond demand curve, which your book does not put DD, it does BD, bond demand. And so what were we measuring down here? What were we measuring down there? Okay, so the quantity of bonds. And is it physical quantities or? So if this is the quantity of bonds, is that I bought 1, 2, 3, or 4 of them? How much money you put in. So it's really dollar volume of bonds is what we're kind of measuring here. So while it's a quantity, it's still kind of a dollar volume type quantity. So it's the real quantity of bonds. And then for bonds, what goes over here on the vertical axis? The price. Good. Not the interest rate, which it's related, we learned, but we are going to put the price of bonds over here. And so the examples that we went through, we might have had a $1,000 face value bond, but that's not what we're measuring here. We're not measuring the face value, we're measuring the price, which can be one and the same, but usually not. How do they differ? How does the price of a bond and the face value of a bond differ? And why? And maybe that's all one answer there. The price of a bond and the face value of the bond. Rachel?
Yes, the price is what you pay for it, what you're willing to pay for it.
Okay.
The face value is what you're guaranteed to get back at the maturity.
Yeah, guaranteed less any default risk. But like if it's a government bond, that's almost zero. But yeah, what's contracted to get at the end? If the government goes belly up or the company goes belly up, then you have that default risk. But that's right. So the face value was the value on the contract or the bond certificate. That was this little thing. So if it had a face value of $1,000, whoever the issuer of the bond is, if it was President Obama, then the government owes you $1,000 at the end of that term, whenever it is. And if it was a 10-year bond, and now we're 2 years into a 10-year bond and there's 8 years left, now we're talking about this variable, the price. What's that thing worth if the government's making a $100 coupon payment on it? if that is the coupon payment, what is this thing worth if it has 8 years left? And then we use the math to figure out what the present value of that bond would be. And the present value of it is really the price of the bond taking into account the current market interest rates. All right, so that starts to set up our, our demand curve, which is as the price goes down, people are going to buy more of them. Because of the transferability of bonds in the marketplace that's created, it is possible to buy low and sell high, right? More sophisticated instruments allow you to buy high with the option to sell low and make money on the flip side too. So you can make money on both sides of the market potentially. If you think the market, if prices are going to be falling in the future, you can buy an option to buy it later, and that gets a little more sophisticated. Okay, so what did we have last time of the things that were held constant when we drew this? What was our ceteris paribus assumptions? We talked about 4 of them. Wealth, expected returns. What else? Somebody other than Corbin, who's got it down in their notes? Thank you, though. Yeah, Jorge, risk. And what's the last one? Liquidity. All right, so these all shape consumers or buyers of bonds. If those things change, then we may want to increase our bond holdings or decrease our bond holdings. And so we went through the whole process of if I'm wealthier, if my expected returns change for whatever reason, expected real rates, we talked about inflation there. If the bond has become more risky, so a good example of that might be some of these governments that were going under or defaulting on some of their bond issues. The city of Detroit might be a good example of that. So as we started to hear, if the news started to break, hey, there's a chance Detroit might go under, right? All of a sudden, what's happened to the risk of holding onto that bond? It's gone up. And so the demand for those bonds is likely to fall. What's happening probably to the supply of those bonds? People who are holding those bonds, I haven't gotten into supply yet, but people who are holding on to those Detroit bonds, what might they tend to do? Sell, right? Increase the supply of bonds. So we got the demand falling and the supply increasing, causing the price of those bonds to get real cheap. Because as the chance that Detroit actually defaults, you don't want to be holding that hot potato. So just like any other stock, that it's going to bomb in price. Okay, questions there? All right, before we get into supply, I wanted to show you a picture here. Now we could do a couple pictures maybe. So you've got this in your book, and it's the same up arrows we did before. So increase in wealth, increase in demand. Now, notice that they say the change in quantity demand. I think that's a little, without good clarification of seeing a table, that's a little bit misleading. I think the author does a good job in the text of making that distinction that we want to be careful of always of whether we're talking about the demand curve or a change in the quantity demanded. But at this price, if this bond is selling for $1,100, the quantity demanded is right here, right? As the wealth goes up, the demand curve shifts to the right. So I talked about that being a shifter, and the bond demand curve shifts to this new location, BD2, and that causes an increase in the quantity demanded here. Okay, so I like to think of it more as being a shift. They just isolated the dependent variable over here. So don't let that throw you. risk relative to other assets. If the Detroit bond increases in risk, we decrease our demand, and so forth. So we got that going. This is the one I especially wanted to show. So we got the supply and demand for bonds. What they did here is they put the effective interest rate at different prices of the bonds. So notice we've got a $1,000 bond price, and if we have a bond that is has a face value of 1,000, there's a corresponding interest rate with each one of these depending on what the term is. And so as the price falls, again, it's just a calculation of what the interest rate is that it commands. And so I want you to start having this one-to-one relationship, although it's one-to-one kind of -1, 1 to -1, it's an inverse relationship. So as the price of bond falls from 950 to 900, interest rates are climbing 5.3 to 11.1. There's an interest rate associated with each one of those prices. 17.6, 25, 30. Okay, questions on that graph? We had another name for this in principles class, so it tells the story of why interest rates change. What are the market forces that cause it to change? And so it says, well, suppose interest rates are too high. You know, what happens? And so what is this saying here? What's another word we might have seen for that, those of you who had some surplus? Yeah, a surplus. Not where you're going to go for price like floor. Yeah. If the price was fixed by law, then it would fall into that. But here we're just talking about, suppose the market has bond prices too high for some reason. What is our prediction that will happen? Well, with a surplus, or now we're going to be using the word excess supply. Like here's the quantity supplied, here's the quantity demanded, there's an excess supply, and so prices are going to start to fall. Down here, we had, what do we call this? A shortage. So that it's okay to use that terminology. It's just your book is using other language that's pretty common in a lot of textbooks. Excess demand and excess supply. So now the demand here locally in this market exceeds the quantity demanded, exceeds the quantity supply. And when that happens, prices are going to be bid up. And so that's why we come to this equilibrium where both parties are happy at a price of $850. The quantity of bonds supplied is 300, and the quantity of bonds that people want to purchase, the bonds demanded, is also 300. So we got two happy parties, and so that is our equilibrium, a situation in which we don't expect any change. All right, so let's get into supply next. Let's see, this is out of place. Ha! Okay, so let's see. Let's just call this bond supply. As the price of a bond increases, the quantity supplied increases. Ceteris paribus, holding all of the things constant. This would be the law of supply. in the bond market. So as the price of it, I think it's easier to think about this being companies issuing brand new bonds, rather than my example that I just gave you of somebody holding on to the Detroit bond. In other words, in the secondary market, I think it's better to think about the primary market. What was the distinction between the primary market and the secondary market again? What's going on in the primary market? The first sale of the bond. So that's really the bond proceeds are going to General Motors. Those proceeds are going to the United States government to buy weapons of mass destruction, right? So those are the, so think about the supply curve in this context. I think it's a little bit easier, for the most part, to put on your hat for the primary market. In many cases, it might be also true to think about the secondary market where you're just an investor and you're holding on to bonds and you might need to increase or decrease the supply. But I think for memorizing these shifters, it's a little bit easier. So shifter list. Well, we can start here. So BS shifters. Number one, expected profitability. Expected profitability. So an increase in expected profits leads to what in the supply of bonds? So a decrease, an increase in expected profits. Because everyone's buying them, so that you're talking about the demand goes up, maybe. Okay. So expected profits. Everybody agree with that? Decrease in supply. I heard a couple decreases.
Because it's not expected returns on the bond, it's expected profits for the company. So you're
Okay.
gonna want more money so you can try to generate more revenue.
That's right. So yes, and maybe, I don't know if that's part of, I didn't even catch that. That might be part of the reasoning, that we're not talking about the profits of the bonds, but the profits of the company. We're back to the primary market. Who is supplying this bond? Well, it's companies like General Motors and Apple and some governments. And well, government would be a bad example since they're not supposed to be in the profit business, right? So if there's an increase in expected profitability, then they're looking rosy about the future. And if you're optimistic about the future, what might you tend to do? Why might the bond supply, what's that, Reno? Buy more capital. And in order to buy, if you're thinking capital in terms of machines and buildings, what do companies do to do that? They do the bonds. They borrow, right? So they might be willing to, we might have stock prices doing different things too, but they tend to get in a borrowing mode. Like all of a sudden it makes sense, like we need money now. We could wait for cash flows to build up to a big amount to buy the new building or to do the new expansion. Or, since things are looking so good and since I can prove to a banker that this looks good and I can prove to the general public that this looks good, I might just choose to go borrow the money, right? So we tend to, when profits are going up, when companies are having good profits, they tend to get more aggressive with expansion. And one of the ways they can expand their business more quickly is to borrow. And so they're going to increase the supply of bonds. So an increase in expected profits, again, you might put a little note to yourself that this is for the company, leads to an increase in the bond supply curve, a shift to the right. Now I want to add a little note that might support this too. So note, during an expansion. Now, what do I mean when I say that? In this class anyway. During an expansion or an expansionary period, what does that mean? GDP is going up, great. Okay, so there's a general uptick in activity, not just for this particular company, but for all companies, right? Because we're talking about the dollar value of all final goods and services sold within the nation's boundaries over the course of a year. GDP, gross domestic product. If GDP is starting to go up, that's a general expansion of all economic activity in the nation, right? So during an expansion, we also have profit expectations high. So it's not only this business, but many businesses, which gives us more reason to think here that as there's an expansion, a lot of businesses are going to start borrowing. Not just a few, but a lot. And so we'll see an increase in the supply of bonds in the market. So during an expansion of real GDP, I'll just add that for fun. During an expansion of real GDP, there is generally an increase in profit expectations for all companies, or for most companies. Okay, questions on that one at all? Number 2, expected inflation. Expected inflation. So if there's an increase in future profits, or I'm sorry, not profits, future prices, so the price level is expected to increase. I need to take the cap off first. What do you think goes on here with the supply of bonds? I'll give you a hint. You need to think about Mr. Fisher, Irving Fisher. So, good idea. Let's flip. Fisher. What's the Fisher thing about again? What did old Irving Fisher come up with? Colby, did you find that? Negative. We'll make it a positive. Or were you here last time?
Yeah, I was.
Okay. You guys should have the Fisher formula down. What was the Fisher formula? Something you should have memorized, by the way, too. Real interest rate equals nominal minus inflation. Good. Is this ex ante or ex post? Post. Good. What does that mean again? After the fact. So we learned it after the fact. Now that's not what I'm asking here. This variable, I've got the expected inflation rate. So I'm asking an ex ante question, right? How am I going to behave today based on something in the future changing, right? So ex ante, if I expect inflation to be different, if there's an increase in this, what's going on? What is this equation telling you? Real's going to be lower, right? So my expected real return, because I don't know this with certainty now, so now this gets a little bit of an I. This one, by the way, I do know with certainty, right? That's today's interest rate. So that's something that I can contract. So putting a little e on this makes this have a little e. And so if this is going up, my expected real interest rates are going down. Now, the question today, what happens to the supply of bonds because of that? So the increase in this leads to a decrease in this. What happens to the supply of bonds?
Bonds are used to fund projects and stuff by businesses, so that they think the rate of return on investments is going to be lower, less than the supply of bonds.
Well, this is our expected real rate of borrowing. So the business is thinking to themselves, this is the amount I really have to pay back. It's going to go up, right? Because borrowing is now cheap. So businesses take into account inflation. If they can pay back with cheaper dollars, it's a better deal overall. So again, if interest rates are 5% and inflation is 0, 5 minus 0 equals 5. What I'm really paying back in terms of purchasing power is equal to what I was doing. However, if inflation is 5% and interest rates are 5%, then I'm really getting a free loan. It's an effective 0% loan. So do I want to borrow a lot of money as a business? Yes. And again, putting my bond supply hat on, I'm going to want to borrow a lot of money because it's really cheap now. That'll be the interaction of supply and demand. So as we start to see businesses increasing the supply of bonds, right, that's going to drive down the price of bonds, and interest rates are going to be going up as well. So there's going to be an interaction of the two. So there's always somebody willing to buy at those amounts, but they're going to change their behavior too. Right here. So there is going to be another effect. We're not talking about that side of the equation, but what did we learn, I guess now that you brought it up, on our demand side with an increase in expected inflation? A decrease in demand, right? So as supply might be going up, but demand's going to be falling, causing the price to fall quicker. And so if the two cancel out, Reno, then we might end up with the same quantity being exchanged at a lower price, which is a higher interest rate too. Okay? All right, so yeah, this is one of those that can kind of reach both sides of the market. All right, so an increase in expected inflation lowers the expected real interest rate that they'll be paying, leads to an increase in bond supply. So you got the Fisher formula to support, and maybe I'll just make one comment here that says the real rate of interest the firm expects to pay back is less. So let's borrow more, is their response back to that. Let's increase the supply of bonds. All right, any other questions on that one? Number 3, the government budget. Or lack thereof. So, an increase in the budget deficit increase in the budget deficit. So what's the deficit again? They spend more money than they collect in taxes. Yeah, not the cumulative, that's the debt. It's important, I'm glad you brought that up. It's important to keep those two things straight. So in a given year, if we're looking at the bond market today for the next month or the next year, and the government has a big deficit projected, in order to pay for their weapons of mass destruction and other spending that they want to do, they have to borrow. So an increase in the deficit leads to what happening in the bond market? The supply of bonds. An increase. So the government now is the cause, not businesses per se. So that's going to lead to an increase in the supply of bonds. So government needs to increase borrowing to pay for spending. So over here, what is the predicted effect of the government entering the bond market because of a deficit? What's your predicted effect on price? Price goes down, interest rates go up by definition. So price of bonds are falling, interest rates are going up, and how do you think that affects private businesses who are trying to borrow to invest in their new innovations and new things that they want to do and expansions that they have in mind? So price of bonds fall because of the deficit, interest rates rise. What happens to their level of borrowing? It's hurt, it's more expensive, right? So we called that something in macro class. Anybody remember that? It had a special name I spent a little bit of time on. So interest rates go up and it's crowding out private investment. It's crowding out private investment. It's the crowding out effect. So that's an important effect here because we've got, private businesses that we rely on to create jobs, et cetera, expand the economy, expand their businesses or whatever. The government not being fiscally responsible with their books causes an increase in the interest rates, causing them more harm that they have to pay, so they borrow less for computers and buildings and machines and that sort of thing. And so that is an important part because it leads to capital depletion in the United States. So there's less capital out there, and we learned from some of our previous stuff, if businesses have less machines and less buildings and less stuff, and they don't make stuff, they can't by definition. So crowding out effect. So we want to put that little hint in here. Wait, I think we talk about that a lot later, but crowding out effect of government. And that is I'll just continue on this chain here. The increase in bond supply leads to a decrease in the price of bonds and an increase in interest rates, which leads to a decrease in private investment. Private investment by firms, by companies. And that's the big potential drag on the economy. It's certainly not helping us get in the right direction. Okay, I think I'm going to go to the screen here for... Does anybody got any questions on that?